All right, are we back? Are we back? All right, I had to switch some things up. Something was going on with my internet. I don't know what happened with the internet. I took the vertical off. Now I'm only exclusively on YouTube. Um, yeah, and it really just got in the middle of some stuff. So let's just check, double check, make sure we're live, we're good. Can I hear me? Wow, that was stupid. Oh, OBS Studio, open mic. All right. And so now, so because before I wasn't even able to schedule them, so now I can go back to scheduling, but the internet is still acting crazy. Let's do this one. Mic check, mic check. 1 2 1 2. All right. Are we live? Here? Can we hear? Do we have sound? Can I hear? Can we hear? We can hear that. But that's a huge delay. The stream will what? It it has something underneath the stream, and I do not know what it is saying. Or look, if this bitch is up or not, I am. It does not matter. So it doesn't want to break down, doesn't want to break up. Yeah, this shook me right here. That definitely shook me. Sheesh. What is this? gotta move on from that. Either this is gonna work or not. I still gotta trade. I'm still going for the downside gap fill. That's good. We're gonna have to definitely fill that gap. 2 more hours. 2 more hours. I didn't know Amit is still alive. Oh, he's talking to someone. Hold on one sec. There we go. Let's get him up here. This is gonna be important. Yeah, this is nice. Above 128. 128. I don't know how my shit is just crazy. Crazy. Crazy, crazy, crazy. Insane. The 82. So whack, man. So whack. So whack. 82% receiving enough video to maintain smooth buffering. It's 100. So I have to change my buffer probably. 120. I don't think I can do it right now. I may have to do it later. There we go. I gotta change my bit rate. Base resolution. I thought I changed that stuff. Wow. Wow. All right, let me go grab a drink. I gotta refocus. Start making me my little mixed drink. Red Bull. Oh, I already had one up here. Red Bull and water ice. Probably not the healthiest thing, but it's delicious. The market is definitely detached. People that's not in the stock market, they see other people that's in the stock market. There's a difference. There's a difference. I did get a pack, right? Yeah, I thought I did. Yeah, more gap. Probably see it better on the 15. Mm. Mm. Alright. Nope, we don't have the data. I mean, consumer sentiment. PPG, isn't that that sounds like energy, gas, or energy. What's going on now? We had that little bit of gap to fill. Oh, they had the Louvre subspecs. The Louvre heist. They still haven't recovered the jewel. That's cool. I heard. Ooh, I heard that wasn't even like a professional heist. It was just like a smash and grab. Huh. All right. Let's gain our composure. I had to do a lot of stuff to get back online. I tried like 2 other times, 3 times, 4 times total. Restart the computer. Before that, I tried looking at the internet and everything. Just all this dumb stuff is going on. All right, what kind of trading is this? thing is starting to pick up some steam. I'm going to the upside. That was kind of bubbly right there. I was thinking about making a, but no, 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 no. Ooh, Bitcoin selling off. Ooh, there's an outage. There's another AWS outage. Oh wow, 16,000 reports. Ooh, this is not good for AWS. Oh wow, Amazon's giving 90-day severance. That's kind of cool. That's really cool. A lot of people. There's a lot of layoffs going on right now. Let me check because my stream can be down right now. I wouldn't even know it. Are we down? You playing POE new league? Yeah. Is the new league out now? We can put it there. 687. 687.59. All right. So, our checklist. Let's go back to our checklist. All right. Um, I'm sorry. I got really frustrated back there. All this stuff happened to my equipment, internet down. Well, just the internet down. Like, what the hell, you know? All right. We look for the gap up. We got the gap up. We got our puts, ball puts. Now, this could be lower day. We think we have lower day. You know, we're looking for power. Now we're going to probably ramp into power. That's what it looked like from what was that, 1204? From 1204. You know, we didn't quite get open the gap, but it doesn't have to be so definite, you know. So you got to look out for things like that. Let's check out the Max 7. Let's put them over here. Apple's Thursday after hours. Apple, Amazon. What is Apple and Amazon doing right now? Amazon, Apple, Amazon. Staying above print. The longer it stays above print, the longer it's going to rally. You know, it came down, it tried, got rejected. That could just be a good thing. Extension to the trade. Wow, an extension on the trade deal. And reduction in tariffs. got about an hour and a half. All right, let's snag a bite. Mm. It's- And now's a good time for a Red Bull. Oh, ew! I don't want all that stuff. At the bottom of it, you see all the syrup. Yeah, you can keep all that. I don't want all that. All right, look like we shift sentiment. I don't think we're going for that downside gap fill anymore. I mean, which team can crashes into it? You know, either have no play or be leveraged out. You know, go 2 to 1 on a side. You know, if you think you're gonna, if you're heavy bullish, calls the one put. If you're bearish, right, 2 puts to 1 call. You know, you can measure them out the right way. You know, to where you can, you know, there's many different ways to write it. You can write it to where your put it can be a little bit more expensive to give you a little bit more cushion, and you can have your calls that have enough strength, you know, to cover the put. You know, you're just putting out a spread essentially at that point, but that'd be efficient. But I'm thinking about selling a put. I want to sell a put for OpenAI. That's what I really want to do. This is good. Yeah, we definitely switch sides. We definitely switch sides. That was a mistake anyway. That was a big mistake. Not a big mistake. That's delicious. What are you talking about? You again? I don't want to hear from you. Maybe even Bloomberg. Give me Bloomberg. All right, we gotta kill some time. We got about an hour before J Powell. We're gonna lay a framework. Right now, I want to lay a framework out. There's a good chance we might be bullish going into Powell. That's crazy. Target at $100, dude. Oh my god, that was my first big owie to options. I shorted Target during earnings a few years ago. You guys want to know how to turn 20K into 10K? Hmm. When the tide goes, you find out who's naked. That's scary. Mm. Those. I thought it was those. I was like, what? Okay. I was like, damn, shit's starting to pop off already. All right, no. No. Things are going as planned, just not popping off. Sorry about that. All right, now we are under. Well, no, I won't say that, but the AWS is messing up again. Azure, Xbox is down. Excuse me, sorry. What is that wall? Oh, Why is so much resistance? Oh, look. Ooh. What else is here? This is a level. This is a level. I like to come here on the bigger screen so I can look at the histogram. We're gonna 2 o'clock. We have 1 hour. 1 hour. We're gonna probably see something pop off at like 140. We're gonna see some action. That's a good stretch. That's a good stretch, man. Woo! Sometimes you gotta. Woo! Alright. Damn, Bitcoin's at 111. Damn, hit that 126 or 127. 124. I thought it hit. Mm, 124. What's up? Halfway here. Oh yeah, that's what's up. That's what's up. That's my pops, man. I love my pops. That's my man. Mm. Pre-market 15. This is 3 o'clock right here. 3 o'clock, 2 o'clock, 1 o'clock. Sheesh, I didn't even know it was 1 o'clock now. Huh. All right, so 1, 2, 3. So we're a little bit in the 1 o'clock right now, and it's bearish. Excuse me. Um, this is Fed minutes here. Trump comes on around here. And then we're going to figure out what's going to happen. So we're going to get a movement in here, big movement in here, a lot of volatility in here. So there's a chance before we get here, we can go back here. That's what they're kind of shooting for. Oh, this is so good. If you want a good drink to try, get the green Red Bull and mix it with a water ice, Philly water ice. It's delicious. There's a lot of chop here. There's a lot of indecisiveness here. I'm waiting to hear. There's some stats I'm looking for right now. You know what? Let me run to the bathroom. I'll be right back. All right, we back. Excuse me. I came back just so I can do that in the mic. No, I didn't. I'm sorry. That the second one, I was like, fuck it, it's already out. But the first one, it just came out of nowhere. I'm sorry. I thought I got all my burps and farts out before I came back. I guess not. I was running back, and I guess got some more bubbles. Got some more bubbles in me. Shake up my stomach. I'm shaking my stomach up right now. Mix it, get some more bubbles. Uh, This can be crazy. It's going to be crazy. Hmm. Oh, those are free. Those I got those free from yesterday. Hmm. It's a, calls are expensive. Wow, man. Mm. Wow. I am nervous, 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 nervous. You know, they can just put that right there in front of us just so we can be afraid of it, or we're going back. We're going to see. You know, my bet is up. I am bullish. I am bullish. FOMC decision, 8 minutes. Oh my God. Oh, let me use the bathroom. Press conference at 2:30. I'll be right back. I'm back. I've been back for a couple of minutes. I just forgot I was on mute. Ooh, this is nervous. Those puts are starting to put. Yes.
Still working?
Yes.
All right. Come with that. What I did so far and get 10.
Okay, well, I'm not gonna be able to go out there for a while. Everything's popping off right now. Please get in, stay in, no in and out. TLT down, gold mooning. Waiting for Power to talk. This is really bullish. J Powell. Market's necessarily up. All right, we got the 25 BP cut. Is he delayed? Yeah, he's delayed. Ah! Ah! That's fucking God. Ah! That's fucking God. That's fucking God. That's fucking God. Like we're gonna get past. So either everything's priced in over the past couple of days, or that's that. Ouch. All right, let's get more of a confirmation. All right, so we actually Pulled something in over there. Those were tags. All right, we're good. We are good. We got some auto sells off. All right, looks like we're waiting on Daddy Pile. Daddy Pile! Daddy Pile! Hey, Daddy Pile! Hey! $29. All right, let's. All right, so we survived the notes. Okay, the market did what it's going to do. It still looks strong. You know, now we're waiting on Daddy Powell at 2:30, and we're waiting on Trump. This was very mild. This was mild, mild. Never seen a mild FOMC like this before. Never seen it like this before. This is a very, very mild FOMC meeting. All right, so now we are back. Is this high day? 6-6. We're high. 689.70. No, 689.70. 689.70. Back at 10. That was high day. Back at 10. High day. All right. We are turning. We could be selling off. Yeah, we are. 217, 687, 33, 687, 33. Middle of day. All right, pause in 15 minutes. All right, let's look for candles. Let's look for some handles. I mean, shooting stars or hammers. That's a hammer. That's a beautiful hammer. There's a little bit of a top right there. It's not perfect. It's okay. Too big of a body. Perfect hammer. Perfect hammer. Too short of a body for a star. Hmm. Moments away from Fed's pow. Mm. Mm. No magic, no real magic today. Just just some hits. Nothing crazy. Nothing to be excited about. So far, it's still early. It's still early. And J Powell didn't even come out yet. Damn. Jump on some Path of Exile or something. We still got earnings. We got big earnings tomorrow. So that could be something. Apple. Who is it tomorrow? Apple, Amazon, and Coinbase after hours. I mean, there's other people, but those are the big ones. Wow. Nothing burger. You are leaning. Mm. Mm. Well, what are we looking at? We're looking at support. We're looking at a support. Okay, support is like a floor, something you walk on, and we're walking on this line right here. All right, we're not falling. You know, there we go. That floor. So that's good. I guess that can keep the bullish sentiment right there. This is a little bit of a slope down. Even back here, 687.59, 687.33. All right, a little bit lower. It's a little bit lower. So, I guess until we break that, we should probably worry that we're going to keep going down. That's not quite a hammer. No hammer, no hammer. Hammer can be green or red. No, no, no. No, no, no. I'm just looking for like some type of indicator, some type of, some type of weakness, a tell. A tell. That's all. If you stop QT, cutie pie. That's thicker than most. Oh. I can be all three, but I can lay the pipe. Come with me, come stay tonight. Hey, ma, what's up? We can get it on tonight. Market is about to crash. That it seems kind of. I am not gonna lie. We can get it on tonight. Whoa. Whoa, Kevin. I don't know. That's wedgy. I mean, that's wedgy. We can break either way. Break hard either way. What the hell? What the hell? Look at that. Is that weak selling pressure on the downside? Is that what that means? This is descending. We're descending on the one like a mother. You can see it on the 5. You can see it on the 30, and we still have the gap to fill. It was a wedge. It did. It was going to do something abrupt. Either it was going to go up or down abruptly. They might do this cycle over again. They can just do this cycle over again. You see, little consolidation, a little bit more consolidation, and look at it's symmetry. This is perfect symmetry. Perfect symmetry. Look at that. Bang, bang. I think there's a chance they can, or since they did this side, they might do this side. Are these guys doing this on purpose? Are they painting this on purpose? No, because this is supposed to go down there. Well, boom. Okay, copy that. And then we're going to see some red. They're going to bring it right back down. So what is that saying? Is that saying we're trying to break and their whole and sellers are strong? J Powell is not late. He's on CPT time right now. He is not white people late on time. Oh, here you go right here. I'm late. Oh shit. Because I'm paying attention to the wrong shit.
Has been expanding at a moderate pace. GDP rose at a 1.6% pace in the first half of the year, down from 2.4% last year. Data available prior to the shutdown show that growth in economic activity may be on a somewhat firmer trajectory than expected, primarily reflecting stronger consumer spending. Business investment in equipment and intangibles has continued to expand, while activity in the housing sector remains weak. The shutdown of the federal government will weigh on economic activity while it persists, but these effects should reverse after the shutdown ends. In the labor market, the unemployment rate remained relatively low through August. Job gains have slowed significantly since earlier in the year. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Although official employment data for September are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue to decline. In
That's
this less
good.
dynamic and somewhat softer
That's
labor
bullish.
market, the downside risks to employment appear to have risen in recent months. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our
think a
2%
lot, but
longer-run
still bullish.
goal. Estimates based on the Consumer Price Index suggest that total PCE prices rose 2.8% over the 12 months ending in September, and that, excluding the volatile food and energy categories, core PCE prices rose 2.8% as well. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or two or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 3.75% to 4%. Higher tariffs are pushing up prices in some categories of goods, resulting in higher overall inflation. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside. A challenging situation. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. Our framework calls for us to take a balanced approach in promoting both sides of our dual mandate. With downside risks to employment having increased in recent months, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance. With today's decision, we remain well positioned to respond in a timely way to potential economic developments. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. We continue to face two-sided risks. In the committee's discussions at this meeting, there were strongly differing views about how to proceed in December. A further reduction in the policy rate at the December meeting is not a foregone conclusion. Far from it. Policy is not on a preset course. At today's meeting, the committee also decided to conclude the reduction of our aggregate securities holdings as of December 1. Our long-stated plan has been to stop balance sheet runoff when reserves are somewhat above the level we judge consistent with ample reserve conditions. Signs have clearly emerged that we have reached that standard. In money markets, repo rates have moved up relative to our administered rates, and we have seen more notable pressures on selected dates, along with more use of our standing repo facility. In addition, the effective federal funds rate has begun to move up relative to the rate of interest on reserve balances. These developments are what we expected to see as the size of our balance sheet declined and warrant today's decision to cease runoff. Over the 3.5 years that we've been shrinking our balance sheet, our securities holdings have declined by $2.2 trillion. As a share of nominal GDP, our balance sheet has fallen from 35% to about 21%. In December, we'll enter the next phase of our normalization plans by holding the size of our balance sheet steady for a time, while reserve balances continue to move gradually lower as other non-reserve liabilities, such as currency, keep growing. We will continue to allow agency securities to run off our balance sheet and will reinvest the proceeds from those securities in Treasury bills, furthering progress toward a portfolio consisting primarily of Treasury securities. This reinvestment strategy will also help move the weighted average maturity of our portfolio closer to that of the outstanding stock of Treasury securities, thus furthering the normalization of the composition of our balance sheet. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting our maximum employment, bringing our inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Nick Timmeros of the Wall Street Journal. Chair Powell, are you uncomfortable with how market pricing has assumed a rate cut is a foregone conclusion at your next meeting?
Well, as I just mentioned, a further reduction in the policy rate at the December meeting is not a foregone conclusion, as I've just said. So I would say that needs to be taken on board. We had, just say this, 19 participants on the committee. Everyone works very hard at this and takes their obligations to serve the American people very seriously. And at a time when we have tension between our two goals, we have strong views across the committee. And as I mentioned, there were strongly differing views today. And the takeaway from that is that we haven't made a decision about December. And we're going to be looking at the data that we have, how that affects the outlook and the balance of risks. And I'll just say that.
You and some of your colleagues have framed last month and maybe today, I won't put words in your mouth, there's a risk management exercise. At what point do you conclude that you've taken out enough insurance? Are you looking for some kind of improvement in the outlook, or could this unfold along the lines of last year, where you made a sequence of adjustments and then waited to gather more information?
So the way I've been thinking about it is the risks to the two goals. For a very long time, the risk was clearly of higher inflation. And then that has changed now. And as we saw particularly after the July meeting, we saw the downward revisions in job creation, we saw a very different picture of the labor market, and it suggested that there were higher downside risks to the labor market than we had thought. And that suggested that policy, which we had been holding at a I would say modestly, others people would say moderately restrictive level, needed to move more in the direction over time of neutral. If the two goals are sort of equally at risk, then you ought to be at neutral, because one of them's calling for you to hike and one of them's calling for you to cut. So if that got back into balance, then you'd want to be roughly at neutral. So in that sense, it was a risk management. And I would say the same about today, sort of the same logic. But as I mentioned, going forward is a different thing.
I'm Claire Jones, Financial Times. Thank you for taking this question. We've just heard from you that the discussion in December and the conclusion of the discussion is not a foregone conclusion. I'd like to just dig into that a little bit more about what sort of arguments were brought up. Was there any consideration, for instance, of the investment we're seeing in AI and some of the generation of household wealth through rises in stock prices related to the AI boom? Thank you.
I wouldn't say that's a factor in everyone's assessment of the economy. I wouldn't say it's the driving factor. I don't think for anybody. I guess I would say it this way. Once again, I would just point out that we have the situation where the risks are to the upside for inflation and to the downside for employment. We have one tool. It can't do both of those. You can't address both of those at once. You've got a very different situation. So you have some people have different forecasts, right? So they'll forecast faster or slower progress on one or the other. And they also have different levels of risk aversion. And some will be more averse to inflation overruns, and some will be more averse to underruns of employment. And so you put that together, and as you can see from the SEP and from the public discussion that goes on between the meetings when more participants go out and talk, they're very disparate views. And they were reflected in strongly differing views in today's meeting, as I pointed out in my remarks.
I was so levered out for
To
that.
say that, that
I
we haven't made a
just
decision
took my freaking
about
things up.
about December. I always say that. It's a fact that we don't make decisions in advance. But I'm saying something in addition here, is that it's not to be seen as a foregone conclusion. In fact, far from it.
Can I just ask a quick follow-up on QT? How much of the fund impressions we've seen in money markets are related to the US Treasury issuing more short-term debt?
That could be one of the factors, but the reality is we've seen, the things that we've seen,
that's the 30-minute.
higher repo rates and federal funds rate moving up. These are the very things that we look for. We actually have a framework for looking at, what the place we're trying to reach. What we said for a long time now is that when we feel like we're a little bit or a bit above what we consider a level that's ample, that we would freeze the size of the balance sheet. Of course, reserves will continue to decline from that point forward as non-reserve liabilities grow. So this happened, some things have been happening for some time now, showing a gradual tightening in money market conditions. Really in the last, call it 3 weeks or so, you've seen more significant tightening, and I think a clear assessment that we're at that place. The other thing is, the balance sheet is shrinking at a very, very slow pace now. We've reduced it by half twice, and so there's not a lot of benefit to be holding on to get the last few dollars because, again, the balance sheets, the reserves are going to continue to shrink as non-reserves grow. So, there was support on the committee as we thought about it to go ahead with this and announce effective December 1 that we will be, freezing the size of the balance sheet. And the December 1 date gives the markets a little bit of time to adapt.
Keep playing out.
Colby. Thank you, Colby Smith with the New York Times. So much of the rationale for cutting interest rates, even as inflation moves away from the 2% target, seems to be, that there are these mounting downside risks to the labor market. But if those don't materialize, and the labor market either stabilizes around current employment levels or even starts to strengthen somewhat, how would that change your perception of how much interest rates need to fall from here? Would you then be a bit more concerned about underlying inflation and the possibility of second-round effects from tariffs?
Yeah, in principle, if you were to see data that suggested that the labor market's strengthening or even that it's stabilizing, that would certainly play into our decisions going forward. So, we do have, we get some data. The labor market is a place where we get, for example, we get the state-level data on initial claims, which are sending a sort of a signal of more of the same. We also get job openings, and we'll get lots of survey data. We'll get the Beige Book and things like that. So we'll have a picture of what's going on in the labor market. And the fact that we're not seeing an uptick in claims or a downtick really in openings suggests that you're seeing maybe continued very gradual cooling, but nothing more than that. So that does give you some comfort.
But if this shutdown lasts a while longer and you don't have that data in hand, I'm just wondering how that hinders the committee's ability to assess the state of the labor market and make the right policy decisions, and also how much is that factoring into the debate about December?
Yeah. So we get. Like I mentioned, what we get in the labor area, we get some data in inflation, some data in economic activity, and we'll have a picture of what's going on. We also will have the Beige Book
go
again.
into risk control.
I would say we're not going to be able to have the detailed feel.
I had to immediately go into risk control.
But I think if there were a significant or material change in the economy one way or another, I think we'd pick that up through this. So in terms of how it might affect December, it's really hard to say. December's, the meeting's, I guess, 6 weeks away.
Wow.
We just don't know what we're going to get. If there is a very high level of uncertainty, then that could be an argument in favor of caution about moving. We'll have to see how it unfolds.
For him to stop talking.
Steve Leisman, CNBC. Mr. Chairman, can you characterize the meeting in terms of, you said strongly differing views. Was this a close call, this cut, or was it a close call maybe the other way because you had dissents on both sides? Thanks.
So I was referring to the discussion about, to the extent it related to December. You saw we had two dissents.
All right,
one for 50 and
684.
one
Did
for
you
no
feel that
cut.
gap?
So, that was a strong, solid vote in favor of this cut.
Oh, the 682!
differing views were really about
My
about the
682
future.
put.
What does that look
Oh
like?
my
And
God.
I think people are saying, you know, they're noticing stronger economic
Oh
activity.
my
You know,
God.
forecasters generally, broadly, have
We
raised
slammed
their
down, we hit
economic
that
growth forecast for
682.
this year and next year, in some cases quite materially.
Wow.
In the meantime, we see, you know, a labor market that's kind of, I don't want to say stable, but it's not
Wow.
clearly in motion.
So that was
It's not
clearly on the table
declining
today.
quickly in any case. It may be just continuing to gradually cool. And again, people have different forecasts and expectations about the economy and different
That stings a little bit.
risk tolerances.
I had
And so
that
there's
682.
you know, you read the
I
SEP, you
had
read the
that
speeches,
682.
you know there are differing views on the committee, and to the point where I said what I said.
And just to follow up on the balance sheet, if you stop at the runoff now, does that mean you have to go back to actually adding assets sometime next year so that the balance sheet doesn't
Interesting.
shrink as a percent of GDP and become a tightening factor?
So you're right.
Hit that
The place we'll be on December 1 is that the size of the balance sheet is frozen. And as mortgage-backed securities mature, we'll reinvest those in treasury bills, which will foster both a more treasury balance sheet and also a shorter duration. So that's what, in the meantime, if you freeze the size of the balance sheet, the non-reserve liabilities, currency, for example, they're going to continue to grow organically. And because the size of the balance sheet is frozen, you have further shrinkage in reserves. And reserves is the thing that we're managing that has to be ample. So that'll happen for a time, but not a tremendously long time. We don't know exactly how long. But at a certain point, you'll want to start reserves to start gradually growing to keep up with the size of the banking system and the size of the economy. So we'll be adding reserves at a certain point, and that's the last point. Even then, we'll be we didn't make decisions about this today,
next
but
leg down.
we did talk today about the composition of the balance sheet, and there's a desire that the balance sheet be. Right now, it's got a lot more duration than the outstanding universe of Treasury securities. And we want to move to a place where we're closer to that duration. That'll take some time. We haven't made a decision about the ultimate endpoint, but we all agree that we want to move more in the direction of a balance sheet that more closely reflects the outstanding
I said
treasuries,
mild.
and that means a shorter duration.
I said
balance
mild.
sheet. Now, this is something that's going to take a long time and move very,
And
very
that thing
gradually.
said,
I don't think you'll notice it in market conditions, but that's the direction of things.
Janelle Marte with Bloomberg. How are officials interpreting the latest CPI report? So some components came in lower than expected, but core inflation was still at 3%. So at this moment, what are you learning about the drivers? And also, do you view that the risks are greater that the Fed makes a mistake on employment or inflation?
So the September CPI report, we didn't get PPI after that, which is important for translation into what we look at, which is PCE inflation. But we can still make a pretty good assessment of what that will be. When we get PPI, there might be some adjustments. But so directionally, it was a little softer than expected, and we always break it down into the three components. So basically, you've seen goods prices increasing, and that's really due to tariffs. And that's compared to a longer run trend of very, very mild deflation in goods. So that's moving inflation up. On the other side of that, good news that housing services inflation has been coming down and is expected to continue to come down. So if you remember a couple of years ago, that's the one that we kept expecting it to do that. Now it's been doing that for some time, and we expect to continue that.
We didn't get murdered.
That leaves
there.
the biggest category is
Of
services
course, we
other than
got
housing
hit,
services.
but we didn't get murdered.
And that's kind of been moving sideways over the last few months, but a significant part of that is non-market
We did
services.
not get
And
murdered.
we don't take a lot of
We got hit.
signal
Of course we
about
got
the tightness
hit.
of the economy from that. So if you add all that up, a couple things to say. One is that
Let's
inflation
go.
away from
Let's
tariffs
go. That's
is
easy
actually
to get
not
back,
so far
baby.
from our 2% goal.
That's
We
easy to
estimate
get
people
back.
have
That
different estimates
little
of what that is, but it might be, 5 or 6 tenths.
120
And so
hours.
that, if it's 2.8, then
We got-
core
we got-
PCE, not including tariffs,
we got some
might be
change.
2.3 or 2.4 in that range.
We got
Something like that.
change,
So that's
baby.
not so far from your goal. So that we look at that, and the thing about tariff inflation is the base case is that it will come and it probably will increase further, but it is that it will be a one-time increase. And, we've been very focused for all of this year at making sure that that's the case and thinking carefully about what are the pathways through which it could become something else, troublesome inflation. One of those would be, a really tight labor market. We don't see that. Another could be inflation expectations moving. We don't see that. So I think, we're watching this very carefully. I think it's not the case that we're just assuming that it's going to be a one-time inflation. We understand fully that this is a risk we have to monitor and ultimately manage.
With the stubborn in services inflation, what are some of the things that the Fed could do to address that, and especially when we're seeing potentially labor supply challenges?
Sorry, say the first.
The stubborn services inflation that you mentioned.
Services inflation, yeah. Well, again, the part of services inflation that isn't coming down as we would like it to is the non-market part of non-housing services. And, overall, that's just something that we expect will come down. The non-market part of it should come down. It largely reflects higher stock prices and financial services that are imputed rather than actually paid is a big part of that. But also just, we think policy is still modestly restrictive in my telling. So that's the kind of thing that should lead to a gradually cooling economy. That's one of the reasons you see a gradually cooling labor market is because, the Fed policy is modestly restrictive. So that should also help get that. I want to say, though, we're absolutely committed to returning inflation to 2%. If you look at longer-term surveys or market pricing, you will see that's a credible commitment, and there should be no question that that's where we're going.
Chris.
Great, thank you. Chris Rugaber at Associated Press. So there's a big investment boom in AI infrastructure right now, as you know, and wondering if the existence of such a boom would indicate that rates are not that restrictive after all, and could further rate cuts at this point perhaps fuel an excess level of investment there or market bubbles? How is the Fed thinking about that?
So I don't think that you're right. There are a lot of data centers being built and other investments being made around the country and around the world. Big U.S. companies are just investing a lot of resources in thinking about how AI, which will be based on those data centers, run through those data centers, is going to affect their businesses. So it's a big deal. I don't think that the spending that happens to build data centers all over the country is especially interest sensitive. It's based on longer run. It's longer run assessments that this is an area
that's money, baby.
where there's going to be a lot of investment and that's going to drive higher
That was an
productivity and that sorts of
overreaction.
things. I don't know how those investments will work out, but I don't think they're particularly interest sensitive compared to some of the other sectors.
And then just a quick follow-up. Could you
That was
mention
an
that you do have
overreaction.
data that
Look
you're
at
looking
that.
at for
Oh
inflation
my
and
God,
growth
look
in
at
the
that.
absence of government data? Could you give us a sense? I think we know a lot about the jobs data that's out there. Can you give us a sense of what you're looking at to track inflation in the absence of government data? Thank you.
So it's a lot of things, and it doesn't replace
tagged the
government data, but
682 too,
you know
that's
all
crazy.
of these. I'll just mention some of the many names: Price Stats, Adobe, and others. For wage inflation, there's ADP data. On spending, you're going to ask about spending at some point. There are lots of other things that we look at, but it's many different sources, and again, including what we get out of the beige
That
book,
was
which will be
crazy.
come out mid-cycle as always. And it doesn't replace the government data, but it gives us a picture. Again, I think
Bro, that
if
was
something material were
crazy.
happening, if there were material developments, I think we would pick that up. I don't think we'll be able to have the very granular understanding of the economy while this data is not available.
Howard.
Howard Schneider with Reuters. Thank you. I just wanted you to elaborate a little bit on what you said a moment ago about the a continued shutdown, making it more difficult to make a move in December. and that may make you more cautious. To the degree you are relying on private data that isn't the gold standard, or that you're relying on your own surveys or the beige book, do you worry at some point you're going to have to start making policy by anecdote?
You know, this is a temporary state of
Policy by
affairs. And,
anecdote.
you know, we're going to do our jobs. We're going to collect every scrap of data we can find, evaluate it, and think carefully about it. And that's our jobs. That's what we're going to do. If you ask me, could it affect the December meeting? I'm not saying it's going to, but yeah, you could imagine that you know, what do you do if you're driving in the fog? You slow down. So that could or could not. I don't know how that's going to play into things. We may get the data may come back, but there's a possibility that it would make sense to be more cautious about moving. I'm not committing to that. I'm just saying it's certainly a possibility that you would say we really can't see, so let's slow down.
As a follow-up, in the debate on this meeting, we saw recently some pretty big layoff announcements coming from Amazon and others. Wondering if that figured into the discussion at all, that you're starting to see this tension between growth and employment starting to be resolved, you know, to the detriment of employment. And secondly, some of the stress is starting to appear in the bottom spur of the K, as they call it, household health premiums that are going to possibly be going up quite substantially, things like that.
What
Has that started to
fuck
become a
did
factor
he
in your
say?
policy discussion?
So those are both things you know, that we're watching very, very, very carefully. To start with the layoffs, you're right. You see
What?
a significant number of companies either announcing that they are not going to be doing much hiring or actually doing layoffs, and
What
much
did
of the time
he
they're talking about
say?
AI and what it can do. So
Oh,
we're
I
watching
got it.
that very carefully.
That's incredible.
And you know, yes, it could absolutely have implications for job creation. We don't really see it in the initial claims data yet.
Oh my God,
It's not a
my
surprise that we
protection
don't.
was
It takes some time
so
for it to get in there, but we're watching
sweet.
that really carefully.
Oh,
But
my
again,
protection
don't
was so
see it yet
sweet. But
in the,
just as we
in
were
the
spiking,
initial
I was
claims
like,
data.
all right, I can let go of the
On
protection.
the K-shaped economy thing, I would say
And
the
I
same
was,
thing.
oh my
or
God, I was
similar
gonna
thing.
start scaling.
We are,
and
if you
just as
listen
I
to
started
the
scaling,
earnings calls or the
I
reports
started
of,
selling.
you know, big
So I started
public
selling more instead of
consumer-facing
scaling.
companies, many of them are
There's
are
no more
saying that there's a
scale, it's all
bifurcated
sell.
economy there.
That's crazy.
and
That's
that,
incredible.
Consumers at the lower
That's
end
incredible.
are struggling
You know,
and buying less
my
and
only
shifting to lower
mistake
cost products, but that,
that
at the top,
I
people are
made
spending at the higher end
was
wealth.
I
Again, they're-
didn't.
so
I mean, I
much,
sold my
much,
protection too early.
anecdotal data on that, and so we think there's something there.
If I didn't sell my fucking protection,
So
if I didn't fucking sell my fucking protection, oh
Thank you. Edward
my
Williams with Fox Business.
God. And it wasn't
so,
even
Mr. Chairman, I wanna
crazy.
take another
I
crack
told
at
you
the-
2 to
at the,
1.
Further
That's exactly what I did.
reduction of rates is not a foregone conclusion.
Oh
So in December,
my
you said
God.
far from it. So if a cut
You
might
see, but that
not
2 to
be on the
1, I
table
made that 2 to
for
1.
December
You know,
because of lack of data,
made that
what
one
does the
kinda
other
strong.
concerns then stem from?
you know,
So
so
if it's
like
not lack of
I'm
data,
writing strong
as
contracts.
there is
I'm
in
not writing
December,
like, you know, like
is not
small
a
weak
foregone
contracts.
conclusion. What other
But
things
man,
could be
oh
the concern then?
man.
well, the perspectives of people on the committee that,
Fuck.
you know, we've now moved
I'm
150
always right
basis
there,
points,
bro.
and
That would have
we're
been it
down
right there.
into a-
That
you
that would have been
you're
it right
into
there.
but
I don't
that
even want to talk
range
about the
between
numbers.
3 and 4, where most
I will talk about the play.
estimates of many estimates of the
You gotta
neutral
know
rate
this number's
live
crazy
in
because
that 3 to
I'm
4
fucking
percent
pissed about
area.
it.
You're there now. You're above
Yeah.
the median number for the committee, but I think there are people on the committee who have higher estimates of the
Wow.
neutral rate, and that's
Wow,
you know,
wow,
you can
wow.
argue these positions since it can't be directly observed. The
Ah.
neutral rate. So
That would
you know,
have been
I
a
think
big payoff.
for
Big, huge.
some part of the committee, you know, it's time
payoff.
to
I was
maybe take a
literally
step
like
back and
a minute too early,
and see whether
like
there
30
there
seconds
really
too
are
early.
downside
Like,
risks
literally.
to the labor market, or see whether in fact the growth,
Uh,
the stronger growth that we're
literally.
seeing is real. Ordinarily, the labor market is a better indicator of the momentum of the economy than the spending data. That's the lore. In this case, that gives a more downbeat read. So people just have, you know, again, we've cut 50 more basis points in the last 2 meetings, and there was a sense like, from some, let's pause here, kind of thing, and a sense from others wanting to go ahead. But that's why I say, differing views, strongly differing views.
Yeah, so on that division, then, you're talking about going forward, so what's more important in this division? Is it inflation risks, is it employment risk, or is there a deeper philosophy division among the board?
Look, everybody on the committee is deeply committed to doing the right thing to achieve our goals, maximum employment and stable prices. You have differences on how to do that, and as I mentioned, some of that is different forecasts, but a lot of it is also different risk aversions to the different variables, which is common through all Federal Reserves. People just have different risk tolerances, let's say. So that leads you to people with disparate views. You will know that from the speeches you've been listening to from my colleagues. And so we're at a place now where we have, in fact, cut 2 more times. And, we're 150 basis points closer to neutral, wherever that may be, than we were a year ago. And so there's a growing chorus now.
Trump can give us the
of
0-1-2
like
punch tomorrow.
Maybe this is where we should at least wait a cycle.
To make us
something
hit
like
that 672.
That's what it is.
Are
It's
we?
just what you think it would be. It's
Can we?
again, you've seen it in the
We have
the
another
September summer
imbalance
economic
below
projections.
before
You've
we
seen
can
this
go high.
in the public remarks.
They
of
actually
FOMC
went down for that
participants,
82
and now I'm telling you that's
today.
what you can expect that in the minutes. And I'm just telling you that's what happened in the meeting.
Elizabeth. Thank you so much. Elizabeth Schulze with ABC News. What is your explanation for why the job market is weakening right now, and what will this rate cut do to improve the job market?
So I think there are 2 things affecting the job market, and one of them is just a dramatic reduction in the supply of new workers. And that's 2 things. That's declining labor force participation, which is a cyclical thing, and then there's declining immigration, which is just a big policy change that actually began in the last administration and it has been accelerated now. So a big part of the whole story is that supply side story. Okay. In addition, labor demand has declined, and so the unemployment rate has gone down, meaning that demand for workers has gone down a little more than supply. So that's what's going on, but it is mostly a supply function. It's mostly a function of the change in supply, I think, and many people think. So the question then is, what does the our tool do, which supports demand? And and I would just say, when you're in a situation where job creation, if you adjust for likely overcounting in the way that BLS does its work, is pretty close to 0. So maximum employment doesn't, on a sustainable basis, if you're creating 0 jobs, if it's in equilibrium, if it's in balance, it's a pretty, as I said before, a pretty curious balance. So, I thought, and many of my colleagues thought, in fact, you've seen the last 2 meetings, that it was appropriate for us to react by supporting demand with our rates. And we've done that. We've reduced so that rates are looser. I wouldn't say that they're accommodative right now, but they're meaningfully less tight than they were. And that should help so that at least the labor market doesn't get worse. Though it's a complicated situation, and some people argue that this is supply and we really can't affect it much with our tools, but others argue, as I do, that there is an effect from demand and that we should use our tools to support the labor market when we see this happening.
You also talked about tariffs causing a one-time price increase. Should American household consumers expect that inflation will continue to go up this year because of those tariffs?
So the basic expectation is that there will be some additional increase in inflation because it takes a while for tariffs to work their way through the production chain and finally get to consumers. And we see this now from the tariffs that were put in place now many months ago. We see those effects, but
that was
if you put tariffs in effect, and they've been coming into effect consistently in February, March, April, May, and that's all happening. So that'll continue to happen for some time, probably into the spring. These are not big increases, though. These are 1/10 or so on inflation. They
I
may
am
be big
happy I
increases
took
on a
some dip
particular
off that
product that's
chip,
been tariffed,
because I put
but
some dip on
overall,
that
these are
chip.
fairly modest. I think
Put some dip on
you know,
that
some
chip, and then I
projections
was
call it
like,
2.8%
I looked in the
inflation.
gym, I was like,
You might
woo!
get 2 or 3
I
more
was like,
tenths,
no.
4 more tenths maybe.
Take just
But
some of
then,
this off. So I
as
took
all
some
the
of that
tariffs
off,
are
and then I
in,
put some more protection
they
on.
stop generating inflation.
know.
You've had a
And then
one-time price
as
increase. As long
things
as you're
were
not-
happening,
at least this is the theory. This is how we
you know,
believe and hope
sell out,
that it will
scale
work
out, could go to new
once
levels and
once the last
everything on
tariff
things.
is put on something, at that point, it becomes
Well,
it
this
becomes
is
a higher
crazy.
price
This
level.
goes
but
back up
it
there.
stops going up, if you will. Prices stop going up. They'll
I
just
got
be at that
robbed.
level, and then
Wow.
measured inflation will come
That'd
back
be so
down to
incredible,
non-tariff
but, I mean,
inflation. As I mentioned, non-tariff inflation is not
That's
so
crazy.
far from 2%
1,
now.
2,
Now,
3,
consumers
4,
are
5
not
minutes.
interested in that story. Their prices are
5
higher.
minutes.
More than
they
that.
wiped out a lot of fucking
The reason they're
things.
so
5
unhappy about
minutes.
inflation is the inflation that we
Boom,
had in
boom, boom.
2021, 2, and 3. Because, you know, you can say that prices
it's not
aren't
like there
going
was
up as
anything
much,
over
but
there.
that doesn't
There
mean
was
people
nothing over
aren't
there
feeling those higher
grab.
prices from the inflation
Well,
we had
the gap.
2 or 3 years ago. They are, and that's,
The
I
82
think,
gap.
a large part of why the public, if you sample people,
Wow,
inflation
they
is still
really
very
gonna go
much
back
making
up.
people quite unhappy. Even, you know, and it's nice that, you know, that prices are not going up as fast as they were, but they're still much higher than they were. And it'll take some time for that effect to wear off. As real incomes rise, it will feel better over time, but that's going to take time.
Michael McKee from Bloomberg Television and Radio. Do you have any concerns that equity markets are or are close to being overvalued at this point?
You know, we don't look at any one asset price and say, hey, that's wrong. You know, it's not our job to do that. We look at the overall financial system, and we ask whether it's stable, whether it could withstand shocks, right? So, you know, banks are well capitalized, while some households are clearly under stress. In the aggregate, you know, households are in good shape financially, relatively manageable levels of debt. At the
needs to
lower
stop this.
income
The Fed
spectrum,
chair
you are seeing
only
rising defaults,
speak
particularly
4
around
times
subprime
a year.
auto, but
This is a
nonetheless,
joke. He
in the
contradicted
aggregate,
himself
pretty
several
good.
times.
You don't see, so you don't see too much leverage in the
that
banking
opening
system
statement
or
was
the
a
financial
motherfucker.
system. It's a mixed picture, but it's not an overly troubling picture. And again, I'm not, you know, it's not appropriate. You know, we don't set asset prices. Markets do that.
Well, you must be
Damn,
well
that was
aware
Jay Powell's
by lowering
fart
interest rates,
out the
you're
door.
contributing to additional asset price increases. And I wonder how you balance the idea that lowering rates would help the labor market with the reality that it seems more likely to be stimulating increased investment in AI, which is the rationale for thousands of job cuts that have been announced in the last few weeks.
Yeah, I don't think interest rates are an important part of the AI of the data center story. I think, you know, people think they're great economics in building these data centers, and they're making a lot of money building them, and they think they have very high present value and all that sort of thing. It's not really about. It's not you know, about 25 basis points here or there. You know, we use our tools to support the labor market and to create price stability. That's what we do. That's our 2 jobs, right? So we're here to, by lowering rates at the margin, that will support demand, and that will support more hiring. And that's why we do it. Now, no 25 basis point or even 50 basis point hike is going to be a dispositive thing, but ultimately, you know, lower rates will support more demand, and that'll support hiring over time. And of course, we also have to be careful about this, which is what we've been doing, because we know where inflation is, and we know that, you know, I've told you the story. It's a complicated story, but this is the best assessment that we can make. But you know, because there's uncertainty around inflation and the path ahead for inflation, that's why we're going. That's why the pace we're going has been a careful one.
Victoria. Hi, Victoria Guida from Politico. On AI, I'm just wondering, you know, it seems like a lot of the economic growth that we've been seeing is fed by investments in AI. So how worried are you about what a sudden contraction in tech investment would mean for the overall economy? Is there enough strength in other sectors? And specifically, are there any lessons that you take from the 1990s in how you might approach what's happening right now?
Yeah, this is different. in the sense that these companies, the companies that are so highly valued actually have earnings and stuff like that. So if you go back to the 90s and the dot-com, these were ideas rather than companies. And, so there's a clear bubble there. Whereas I won't go into particular names, but they actually have earnings and, it looks like they have business models and profits and that kind of thing. So it's really a different thing. The investment we're getting in equipment and all those things that go into creating data centers and feeding the AI, it's clearly one of the big sources of growth in the economy. Consumer spending also, though, has been, is much bigger than that and has been growing and has defied a lot of, negative forecasts, continuing to do so this year. Consumers are still spending. Now, it may be mostly higher-end consumers, or maybe skewed that way. But the consumer is spending, and that's a big, big chunk of what's going on in the economy, substantially bigger than AI. You could point to growth. I mean, actually, you may be growth as opposed to level, but consumer spending is a much bigger part of the economy.
And why do you think
I wish
that
I would've
the
hit my
labor market
downside.
is slowing so
Oh
much,
my
even
God.
though consumer spending is
My
strong?
downside was right there,
Why has
too.
it slowed so much? Well, what's happened is
It was
that
right
the
there.
supply of workers has dropped very, very sharply due to mainly immigration, but also lower labor force participation.
Mainly immigration.
And that means there's less need for new jobs because there isn't this flow into the pool of labor that, where people need jobs, because there aren't those people now. So there's not a supply of workers showing up for jobs. In addition, demand has also gone down, and so has labor force participation has declined, which is more of a sign, in this case, of demand as well as trend. So I think you're seeing some softening. The economy's growing at a slower rate than it was, 2.4% last year. We think around 1.6% this year. It could have been a couple of tenths higher if not for the shutdown. And of course, that will reverse. But, you still got the economy growing at a moderate pace.
Andrew.
Hey there, Andrew Ackerman with the Washington Post. I wanted to ask if you could elaborate on how you think about policy in the context of the data drought. Does it make you inclined to stick with your plans as set out in September in the absence of the data that might change your mind, or does it make you inclined to proceed with added caution because of uncertainty?
Yeah, well, we'll know when we face that question, if we face that question. It'll probably be argued both ways, right? But I've said a couple times here that, if you really aren't getting information and you really don't know, and the economy looks like it's solid and stable and hasn't really changed, there will be an argument. I don't know how persuasive it will be, but there will be an argument that, you slow down when you can't see as far ahead. Others may argue, I'm not sure where this argument will come, but you're perfectly right that you could also argue, well, things haven't really changed, but you might not know that, So I don't know whether we'll face this or not. I hope we don't. I hope by the time of the December meeting we're getting, a better flow of data. But if we're going to have to do our jobs one way or the other.
Okay. I also just wanted to ask a FinReg question. I think several years ago you said the overall amount of capital in the system was about right. As the Fed moves forward with a revised Basel proposal, potentially changes to the GSIB surcharge, has that changed at all? Or are you planning to significantly reduce the amount of capital in the system? Thanks.
So there are discussions going on, I think, among the agencies, and I don't want to get ahead of those discussions. I continue to think that the level of capital, when I said that in 2020, was about right. And of course, there's been much capital added since then through various mechanisms. But I look forward to I know those discussions are really just getting going. They haven't come to the point where they're got a whole plan and that kind of thing. So I really don't have much to say on that.
Hi, Chairman Powell. Brian Chung with NBC News. Is the weakness in the jobs market accelerating, and who's at risk if the interest rate cuts are not the effective medicine for a further slowdown in the labor market?
So we do not see the weakness, as you put it, the weakness in the job market accelerating. I would say then again, we didn't get the September employment report, payroll report, but we look at, the unemployment insurance claims, initial claims are reported at the state level, and we still get those, and we can accumulate them and get the national number. And there's really, no story. You can look at the numbers. Same thing with the job openings we get from Indeed. There's just no story over the last 4 weeks. It's kind of stable. So you don't see anything that says that the job market is, or really any part of the economy is making a significant deterioration. Don't see that. You see more things like I mentioned, though, which is you see big companies making announcements of either of layoffs or of the idea that they won't need to hire. Their number of employees is not expected to go up over a number of years. There may be different people working there. They say that too, but they don't need a bigger head count. So you see those kinds of things. You don't see it in the aggregate numbers. The layoff numbers have not gone up, but job creation is very low. And the job finding rate for people who are unemployed is very low. But the unemployment rate is very low as well. 4.3% is a low unemployment rate.
So as you make these cuts, is it the lower income workers that you're thinking about, or those who might have their jobs automated? Is there a particular section of the labor market that you're particularly?
So we can't, our tools don't allow us to target any demographic or any income level and that kind of thing. I do think that people, we saw this during the global financial crisis and the long recovery. If you have a long period of very strong labor market conditions, it benefits people at the lower end the most. The last 2 or 3 years of that long expansion, people at the lower part of the income spectrum were getting the biggest benefits, and lots of things were happening in that space demographically, which were very constructive. And we're not at that place right now. But so, yeah, a stronger labor market is the best thing we can do for the public. It's also part of our job. It is half of our job, but it is absolutely the best thing we can do for people. Along with keeping prices stable. Those two things. Inflation also hurts people on fixed incomes more than other people.
Courtney. Hi, Chair Powell. Courtney Brown from Axios. As you know, the 12 Reserve Bank presidents' terms are up for renewal at the end of February. I'm wondering if you can give us a timeline for when the board will consider those reappointments and whether we can expect everyone to be re-upped or if we can expect some changes.
So it's a process that we go through under the law. The way the law works is we have a reappointment process every 5 years for all of the reserve, each of them and all of them. We're in the middle of that process, and we're going to complete it in a timely way. And that's really all I can say.
Okay, thank you.
Daniel. Daniel Davis, Agence France Presse. You've now had dissents in 3 consecutive FOMC meetings, but in this meeting you had dissents going in both directions, and you've just mentioned there's strong disagreement over the future path of rate cuts. Have these disagreements complicated your role presiding over the FOMC meetings, and if so, how?
I wouldn't say that, no. I think you have to take what comes, and what comes right now is a pretty challenging situation where we have, first of all, we have 4.3% unemployment. We have an economy that's growing close to 2%. So, overall, it's a good picture. It's a good picture. But in terms of our policy, we have upside risks to inflation, downside risks to employment, and this is a very difficult thing for a central bank because, one of those calls for rates to be lower, one calls for rates to be higher. We can't do both, so we have to balance the two. And so it's a challenging thing, and as we have worked our way through this process, you would expect that there would be a range of views across the committee on what to do and the speed with which we should do it. And that's what we have. That makes a lot of sense to me. All of these people are, people who take their jobs very seriously, work very hard at this, and just want to do what's right for the American people, but they have different views on what that is. And, it's an honor to work among people who care that much. It is, but I don't feel that it's unfair or anything like that. It's a time when we're making quite difficult judgments in real time, and I believe we'll get through this, and I think we've done sort of the right thing so far this year. I think it was appropriate for us to be careful about this. I think it would not be appropriate to just ignore or assume away the inflation issue. At the same time, I think the risk of higher, more persistent inflation has declined significantly since April. And if we do wind up resuming rate cuts at some point, we will at some point. I think we're trying to get to the end of this cycle with the labor market in a good place and with inflation, on its way to 2% or at 2%. So that's all we're trying to do, and we're doing it under, quite challenging circumstances and doing the best we can.
We'll go to Jennifer for the last question. Thank you so much, Chair Powell. Jennifer Schonberger with Yahoo Finance. Both regional and large banks have taken losses on loans given delinquencies on subprime auto loans. JP Morgan CEO Jamie Dimon warned, when you see one cockroach, there may be more likely. I'm curious how the Fed is looking at these loan losses and if it poses risks to the financial system or the outlook for the economy. Is it a warning sign?
So, we're obviously, we watch these things very carefully, credit conditions very carefully. You're right. You've seen rising defaults in subprime credit for some time now, and now you've seen a number of subprime credit, automobile credit institutions having significant losses, and some of those losses are now showing up on the books of banks. We're looking at it carefully. We're paying close attention. I don't see at this point a broader credit issue. It doesn't seem to be something that has very broad application across financial institutions. But we're going to be monitoring this quite carefully and making sure that is the case.
And then separately, many, you yourself have said that we're in a bifurcated economy right now with high net worth individuals continuing to spend with the lower income pulling back. How much of consumer spending continuing hinges on the stock market remaining strong? In some odd way, does the market help keep the economy buoyant?
So there's some relationship there, but remember, the more wealth someone has, the lower an additional dollar of wealth matters. So your marginal propensity to consume declines quite dramatically as you reach levels of stock market wealth. So, the stock market, it would affect spending if the stock market went down, but it wouldn't drop sharply unless there were quite a sharp drop in the stock market. People at the lower end of income and wealth have a much higher marginal propensity to consume of an incremental dollar of income or wealth, but they don't have the stock market wealth. So I think it's certainly a factor supporting consumption right now. And you would see it if you saw a material correction in spending, but it wouldn't be. You shouldn't think that it'll dollar for dollar stop consumption, because that wouldn't be the case. Thanks very much.
Wow. Powell, fucking Powell. He did not disappoint with fucking the market up. Oh my God. He did exactly what I beat all them to it. That's why. That's crazy. I can't believe. Yeah. Stock market wealth is different. It's a different kind of wealth. All right, well, that is pile day. Today was definitely bittersweet. It was nothing cool happening. Today was just one. Let's wait and see what happens in the day. Oh, this is selling off. It's the UVIX and VIX. All right, 3:30. 3:30 sell off. The ADP report, that's what it was. Yeah, today was lackluster. we're gonna swing something going into tomorrow. Ooh, sell off. Um, all right. Well, that sucks. I wish I can really take advantage of today, but it really didn't even move. So what are we at? So we had a high of day 688, low of day 82. That's a 6-point move. We're supposed to get a 15-point move this week. Wow. How are you bullish but the market sell off? He's bullish, by the way. This is bullish. This is bullish. All right. What happened? All right. So on my checklist, I did good on my checklist. Look, we caught the gap up. We caught the puts. We sold our puts at lower day. You see, we sold our puts at lower day, then we bought our calls. Okay. As Powell came, then we start buying protection. And then yep, you see, the protection was bought. It was just on the other side. We ripped in the Powell, of course. But that drop off, that sell off, like where did that come from? Where did that come from? That came out of nowhere. Mm. How is this? I'm going over some risks and everything. there's movements at the end of day. It's 339. All right. We gotta wait at 3:45. We have to watch it for the 4 o'clock hour. So trading is essentially no, it's still going on. But I'm trying to see something. Interesting. What am I looking for? Uh, those two. Those are the two. $45. 87. Mm. I don't know. You said that. I don't know. Today was lackluster. It was lackluster. Even with that knife, but the good thing is, even with that knife, I didn't get murdered. I got hit. I was able to manage it. I managed it. It looks like a profit off of it. I took my protection off a little bit too early. I like seconds too early. Like seconds. I usually go back and rewatch my videos and everything, and I'm gonna time it because if oh my god. So how should you hold your protection? Like, should you just let your protection erode, especially such an erratic day? I mean, in hindsight. It's 3:48. Mm. risky levered positions. Wow. Bullish into the end. But not that. Not that. Of course, that one. So when you do something like that, you got to pick that one. It's definitely always going to be that one. There's no fucking way. That's absolutely incredible. That was so criminal. So criminal. No, that's not a good price. Oh no, they moved down there. Maybe I don't think the other ones are moving. Not like that. $87. So we're back to open and print. Wow. Wow, 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 wow. I could have gotten decimated. Decimated, decimated, decimated. But it's just risk management. Manage the risks, manage the outliers. All right. I got some notes for FOMC day. What time is this? 59? No, it's 53. This is a whole nother. You know what? I did everything mechanically except for I took that protection off a little bit too early. That was it. Everything was nice. Everything was nice. No. Sometimes you kill it. Sometimes you don't. You know, what I can take out of this, more notes. I'm happy I didn't come out guns blazing, because usually, I'm a shooter. What do shooters do? A shooter shoot. And I'm damn sure a shooter. Today wasn't it. I took my shot. I missed. I had protection though. I was definitely happy about the protection. I took it off. Mm. Mm. It's 56, 55. Mm. Oh, I still have a reference. I have a note. Wow, look at that. And then we were looking at this. Oh wow, wow. What's that? Plus 1 minus 4. This was plus 1 minus 4, and that's a good ratio. That's a good ratio. I wonder, can you go opposite? Well, I guess we would have to, see that, but um, what's the IV 88? Oh no, wrong one. And 97. 97, 89. That's a little bit more. Well, I mean, it's crazy heavy. Maybe that's the wrong metric I'm looking for. At this time, I'm not really looking for the what's the delta? Where's the delta? That's not bad. I mean, but of course that's going to have such a nice delta. But what about this delta? Yeah, negative 0.18. Those odds are against you right there, of course. This one has more, almost a 50% chance of with this delta. This is 0.42 delta, of course, because it's right there. We don't care about theta at that point in time because we already know what's going on. Price is going down. I'm about to say this delta is going down. You don't care about. I think it's pronounced rho, vega, delta, gamma, theta. The big ones for the Greeks that we really care about is delta, delta, and theta. That's the only two I care about. Not really much gamma, vega, rho. Maybe IB, open interest, big time. I'm gonna start looking at the open interest. I have to get my hands on the ratio of these contracts and everything. All right. I think I got the info that I needed. I think I got the info that I needed. All right, so they brought it pretty much back up. What time is it? 58. When we open up tomorrow, we can definitely open up in this range. What's the low of day? 682. They put us right in the middle. Either way, it's going to be a 6-point swing tomorrow when we open up or down. 2 minutes. We have Google, Microsoft, and Meta after hours. We have a play swinging into tomorrow. So we have one swing play. Alright. Wow. If I didn't sell my uh uh you know, I the hit. I mean, the fact that he came and he reversed the market, of course, you're supposed to get ready for something like that. I wasn't obtuse to the fact that that could not happen. I knew it was gonna happen. That's why I got the protection. And the part is that I fucked up that. All right. That's the stock market today, guys. GG. Good job. I hope you made money today. Right now, I'm just going back into homework. I've been doing homework for like the past like half an hour. Believe it or not. Once I got past all the risk management, S&P actually closed green. That's crazy. Look at that. They are so funny. Oh no. That's $1. Okay. $1 though. They're so funny. Yesterday they did like 3 cents. Between the open and close, 3 cents. That's sick. They did it again. Well, I was ready for you today. Wow. Wow. Today was a big note day. I hope you're taking notes. There is a lot of things I'm listening to right now. How come you guys can't hear it? Yeah, the S&P closed green. Let's look for earnings. Google's 280. What is it? What's the name? You know what? Let me get rid of that. What I want is 26% beat on what? That's crazy. Is that Alphabet? Oh, main sound.
4% in after-hours trading. And it's an interesting company when we talk about AI. It's both a tailwind and it's also a threat here because Google's search business with OpenAI, that just emphasizes some of those competitive pressures. But at the same time, we do see that its Gemini AI models, Google Cloud's AI infrastructure deals with Meta,
increased
and even
CAPEX at Google.
When you look at
we are looking at, that is an increase
out there are super
of,
bullish on this, even having price targets.
Wow.
This might be
Microsoft
an increase share, and we're inching close to that number now, Josh, nearing 200.
That's 92
Microsoft
versus about
dumping
84.5. Google is increasing CapEx by about 9%.
This stock had a
Meta,
Hardly by the way, they missed by
pretty
1% on
impressive
EPS. They
on
beat
the
by
CapEx side.
6% in the after hours. Yes, it's about advertising services. That's
Google,
top line.
Google
So
just
a
hit
lot of
290.
folks,
Google just hit
rightfully
290.
point out, Ali, on that
CapEx forecast.
cloud business, and that did look like a beat. The revenue was
Microsoft,
2.16,
and that is for
5. We have seen
fiscal
a
year.
number of AI deals involving Google Cloud. So in
Your
some sense,
operating
we had
income
a
miss.
EPS on Microsoft, also I think it's
Google double D.
31.23.
Okay, they beat by 13%
from
Microsoft.
Divided
EPS
by
13 looks like they're seeing full year 91 to 93.
32.11 by about 2.7%.
That's a significant rise
And
there.
then
And I mentioned
YouTube
the
ad
competitive
revenue
pressures of
beat.
search continuing to be resilient
YouTube
here.
ad
A
revenue beat,
$56.57
beat.
billion. The
Street loves
estimate
Google,
was for just under
$295.
Cloud
$55
beat,
billion.
search
So
beat.
Google's
search
going
doing well,
crazy
cloud
right
doing
now.
well, increasing that CapEx
So
spend.
it's
We
really
are both the
across
top
the
five lines.
beat on the top line,
Shares are up 6%.
but they kind of miss on the operating side. So Google,
about constantly the products, the partnerships.
how's
what
Google
kind of risk does
moving?
Sam Altman's app post for Google on
Google's up
Twitter this morning
5% on
on
it.
290.
So Google's happy. Okay, Microsoft comes out with revenue 77.67 beat, but the stock's going down. The estimated Q1 revenue was 75, so they beat. Intelligent Cloud
that looks like a
beat.
beat. Looks like
Meta, let me see if I have Meta.
75.55.
And then Azure and other cloud
Q1 Azure, other
revenue
cloud
beat.
revenue.
I mean, this is an across-the-board beat at Microsoft.
39%.
And it's
Q1
falling.
Intelligent Cloud
All
overall.
right,
Google's
so
increasing
our
CapEx
ending
spend. Google is
tomorrow.
now
So
up
tomorrow we're going to rip
7%,
tomorrow.
as
We
CNBC
could
starts
truly
talking
rip
about it.
tomorrow.
And Microsoft is down about
call
4%.
Amy Hood, that's when you
We're
would get
going
the
to
color
open
there.
somewhere
You see the stock
around.
initially you're down about 4%.
Okay.
Yeah, and I'm curious
So,
why
and there's
maybe
no clear
earnings
indication
coming
as to
in,
what the
below
problem is
those
at
expectations. Again,
Microsoft.
we're waiting on that.
Meta comes out.
The intelligent
Reality
cloud
Labs
revenue, that doesn't
470
include the
in
Azure
revenue
business
versus
coming in ahead of
317.
expectations.
That's
Of
a
course,
beat.
we did
EPS
earlier today see a little
$1.05.
bit of
EPS, Meta beat.
Meta went through
Ad
708.
revenue, $50 billion versus 48.5. Operating income up 18% year over year, 20.5.
Google's 300, did we get
This
300?
is good. Family of apps revenue, 50.77 billion versus
I saw
49.5. Effective. Just a beat.
Microsoft heading into
Meta and
Q3,
Microsoft
the setup did
One
look pretty
quarterly
positive. We've been speaking to
includes
analysts all
one-time
week.
non-cash
They have
income
seen
tax
a
charge
stronger
of 15
enterprise
billion.
story accelerating
Q4
AI
revenue
infrastructure
comes in
demand from
at
partners like OpenAI, of course. We have that
slightly
reset
higher than
of that partnership
expectations.
with OpenAI, Microsoft.
So Meta's a beat as
27%
well.
stake in OpenAI's
Meta beat,
profit,
Google double
public
beat,
benefit
Microsoft,
corporation
I think
that's
Starbucks
Microsoft
comp sales come in plus 1% versus the estimate of a decline of 0.48%.
We may
So
open
Starbucks
up,
beats
well, we're
on
going to have to
forecast,
open up
but
to
adjusted
around our
EPS
high of
misses.
today,
Comp sales up
689.
though is bullish.
Guys, I
Even
think I was looking
China
at the right
comp
number.
sales
Or
are
else
up.
we're going to open it down.
Either this is false or
But
if we open up down,
$5.65 billion
that means we're going to open up somewhere around
EPS 103 versus
682.
682 a year ago.
If
And then
we
margin
open up
misses.
682
EBITDA margin
tomorrow,
comes in at 11.3%
we're
versus
grabbing that
11.7
672
expected. But their EBITDA in total comes in at 637 million versus 598. So they're really, they're making good money.
Mark my words on that.
So investors sort of wait
If
and
we
see
open
mode
up,
to see
if
they're
we
what
making
open up down,
developments could
Or,
come in
if this is
on
legit.
the call.
So let's see
because
how.
right now we're at
I am
680,
curious,
we're at
you know,
685.
So
what's
Microsoft
driving
now
share, and
down
I'll dig into this,
4%.
results in the report
Google
a little bit
is
more.
up
Shares down
5%.
Are you seeing Meta yet?
That's right there in the middle, so even
Carvana's
spread.
down
Let's
12
see.
on that
Fourth
beat,
quarter
but maybe the
revenue,
margin
they
miss must
see
be the
that
only thing that's bugging them.
Chad says they're writing on scale.
Wow, that's pretty cool.
You know, if we're
Carvana.
laughing at that, but theoretically, that's what a miss
is up about 2%, which is
Mostly
pretty
coming
nominal.
in line with
And then
expectations.
ServiceNow
taking a nearly
is
16
pretty much
billion non-cash
flat
charge.
because they haven't actually reported yet.
Let's see if we can find the
695. We
EPS.
need some more details on what's happening with Meta.
$1.05.
And then how about
GPUs?
Meta?
Okay, but they've been buying GPUs for 4 years.
Meta.
Wow,
Meta drops 8%.
All right, well,
Let's
this is
listen in here.
FOMC day. We kept it simple. We kept it very simple. We kept it like textbook simple. We didn't just we kept it very simple. You know, today was a wash. I'll see you tomorrow. Technical problems and all, man. Jeez.
Yeah, and China did really well too. Let me go to the Doomers for a second. China was like plus 2% on comp sales, which with the competition in China, that's really impressive. Let's listen to Meta here.
Using AI to boost engagement. I'm trying to look
Yeah,
at
we'll
what
continue
their
to follow
ad
that,
revenue
but
came in.
as
Ad
Ramin
revenue
said,
did
it would
beat
explain some of the negative
expectations.
reaction that we're seeing right now. Meta shares now down by more than 7%. I do want to go to this line.